I'd love for you to join me May 19th at 7 p.m. Central Standard Time, where we're going to answer your questions live on how to rock retirement in this age of inflation and everything else going on, as well as talk about the open enrollment period for the Rock Retirement Club. You can learn more and register at livewithroger.com. John Elliott has some good wisdom about rocking retirement. He says, you will not do incredible things without an incredible dream. Well, hey there, welcome to the show. My name is Roger Whitney. I am your host. Now, this is the show dedicated to helping you not just survive retirement, but to have the confidence to rock retirement. And that goes well beyond the financial things. We got to get the money right. But you got to have a big dream to apply those resources so you can do incredible things. So today we're going to continue our theme of, we're going to focus on your questions, but I got a couple announcements first. One is next month on the show, the month-long theme is going to be functional health in retirement. If you get the money right and you get the dream right, you're going to want to make sure you get your body right as best you can so you can actually do the things that you have imagined in your dreams. And so we're going to bring on an expert and use a planning perspective of how do you plan to be as functionally healthy as you can in retirement. So I'm excited about that. Also in May on the 19th, which is a Thursday at 7 p.m. Central, I'm going to hang out live with probably a few hundred of you, people that listen to the show. We're going to have some live Q&A about inflation, about markets, about how to rock retirement. So we'll just have a good chat and some back and forth on that. And then we're also going to talk about the open enrollment for the Rock Retirement Club, because we're opening enrollment on that day for about 6 days, bringing our next cohort. And our online community, Rock Retirement Club, we have on-demand world-class education on how to build your retirement plan financially so you can have the confidence to rock retirement. We have online meetups every week on the financial and on the non-financial topics so we can coach live with you and everyone else. And then we have a community of over 800 people that are wicked smart, have the same spirit, and are in the same period of life that you are. And so if you're interested in something to supercharge your plans on rocking retirement, check out Rock Retirement Club, and we'll be opening it up for enrollment on the 19th. You can learn more about all this at livewithroger.com. All right. Before we get to your questions and answers, I wanted to share a quick win for me and then a practice that I started about 3 months ago that's really been helpful, and it might be something you might consider. So first off, Roger's win. Well, the other day, I bypassed doing the triple bypass when normally I would say yes. That's a big win for me. Let me explain. So I have a client who is going to be in Colorado in August, and he and some friends are doing what's called the triple bypass, which is a 110-mile bike ride going from just outside Denver to Vail. So 110 miles at altitude because it's high up there. And the triple bypass refers to it goes over 3 mountain passes. So you're doing a lot of climbing. It sounds painful and it sounds something right up my alley. And I really, really wanted to say yes, but I didn't say yes to him. I said, well, let me think about this because I'm going to be in Colorado all of August. So I would be there so I could coordinate it if I wanted to, but I didn't say yes. So that was little win number one. And so I've been noodling on that, talking to Shauna, talking to a few friends, and that same day, we're going to have a 4-hour event for the Rock Retirement Club. So that I would have to move that if I did this. Shauna and I have some family coming in. I'd have to coordinate around that. And I've been wanting to focus on more on mountain biking. So that would change that. And I'd have to start training a little bit harder. All things I'm willing to do for the chance of the experience. But after taking all that all in, I considered it. And I emailed them, no, I can't do this because I made the commitment to the event. It's going to take an extra day and a half away from my wife and my family in a house that we rented in Salida. And that's growth for me because normally I'm all in on doing stuff like that. In fact, one of my goals this year is to start an adventure club, to do adventure. So I'm proud that I had this win to bypass it, even though I would have had a great time. So safe rides, guys. So that was my win. Now, one thing I wanted to share with you, and I think I've talked about this on the show before, but it's been evolving. So I figured I'd bring it up. it's a practice that you might consider doing. I've started a morning routine. So I come upstairs to my office. I stretch for about 5 minutes. I do, right now, it's about 11 minutes of meditation. And then I go to journal, but I don't journal like I write all my thoughts down. Right now, all I'm doing is I write down what I call sharp lines or bright lines. And what I write down is, the first thing I say is, today is the day. Today is the day. And then I write, I am a reader. I don't do social media. I meditate. I do deep work before I have inputs from my phone. I trust myself. And I just write these day after day. Today's the day. I am a reader. I don't do social media. And since those are the two I started with, and I don't do social media. I haven't been on social media in months. I think I checked in once or twice just because I have some people that message me there, but I never go to it. I never have a desire anymore. I say I am a reader. Reading is my default activity. If I'm like in line at Target or something, if I have my phone out, it's because I'm reading a book. So reading is my default rather than web surfing. And slowly, as I'm like, wow, those are easy. I'm writing them every day, but I'm doing them so easy. So now I do deep work before I have inputs, meaning that after I do this routine in the morning, I have a project, whether it's a client project or a podcast project or a club project. And before I touch my phone or receive any inputs from the outside world, I take about an hour, hour and a half, and I just work on that one thing. And I've been adding things to these sharp lines as I perfected the other ones. And I always say today is the day. And I always frame it as this is who I am, not what I aspire to be. I am a reader, not that I want to read more. It's really made a difference. I don't know if it's because it's top of mind or some other things that I'm doing. So if you have something that you're working on, maybe every morning you just write down, hey, today is the day. This is who I am. I am the person that does the dishes. I do dishes or whatever it is. It's really been helpful for me. So I thought I'd share that with you. With that, let's get on to some of your questions. This show is sponsored by Boomer Benefits. They speak Medicare. Medicare is a complicated topic because there is no one size fits all. It really is dependent upon your health and the things that you use. And Boomer Benefits is a great service that helps you make those choices to maximize Medicare for you. And the cool thing is it doesn't cost you any money because it's all built into the system, whether you use someone like this or not. And we use Boomer Benefits in our practice when clients are navigating Medicare. And I would suggest you check them out as well. You can find out more about them at boomerbenefits.com/RAM. All right, now it's time to answer some of your questions on how to rock retirement. If you have a question for us, you can go to rogerwhitney.com/Ask Roger, and you can leave an audio question or a written question, and we'll do our best to get it on the show. Our first question comes from Rob on calculating a net worth statement. Rob says, hey, Roger, when we've calculated our net worth, we've included the bulk amount or the lump sum option of my wife's pension, but she's going to start taking the monthly payment next year. Do you have a recommendation for how we calculate that once she starts receiving the funds for our net worth statement? Well, it's a good question, Rob. To be clear, our net worth statement is a fairly straightforward document that has a list on the left-hand side, usually, in a column of all the assets that you own, your house, your car, your 401k account, your bank account, and it lists the name of the asset, who owns it, and then the value of the asset. And then on the right-hand side, it shows all the liabilities, your mortgage, your car loan, etc. And then it would subtract the liabilities from the assets, and that's your net worth from a financial perspective. And so it sounds like, Rob, you've been including the lump sum or the imputed value that you've been given for this pension while she's been working. But now she's retired and she's going to select her pension payment. And usually, more and more often, there's a lump sum option where you can just take the money and run and move it to an IRA. Or you can turn on the monthly payments, the pension payments. And it sounds like that's what she's going to do. So now is the time, once she turns on those payments, Rob, that this is an irrevocable decision. So you no longer have an asset in the traditional sense. You just have what we would call social capital. That's very similar to Social Security, just guaranteed payments for the rest of your life or whatever option you chose. And you don't put those on net worth statements because they're not an asset you can actually do anything with. It's a payment stream. Where it would show up more clearly is on a household balance sheet, where we bring all the future payments and spending back down to today's value. So where you could include that is on a household balance sheet. And the way that you would do that is you would put in the pension payments on an annual basis, assuming she lives to say 90, or both of you live to 90, and then whether they're inflation adjusted or not, and then create a net present value of the stream of those cash flows. And then that would be represented on your household balance sheet as an asset, just like your spending over the same time period would be listed as a liability. So it comes off the net worth statement, but you could represent it on the household balance sheet, which is something that we like to use. And it's what we use in the Rock Retirement Club in our masterclass. So hopefully that gives you some clarity. Our next question comes from Kevin about interest rate hedged bond ETFs. Hey, Roger, what do you think about interest rate hedged ETFs? I know if rates stay flat or decline, these will underperform, but I think there is greater risk on rising rates than on falling rates. Are these worth considering? The one problem I would have with them is that I'd have trouble figuring out when, if ever, to exit. I'm not a tactical trader, but wonder if a small slice of these might be appropriate for my liquid pie just to hedge some of the interest rate risk of rising interest rates. Well, that's a really good question, Kevin. And so what he's referring to is an exchange traded fund, which is a mutual fund that has a special wrapper that trades like a stock on the stock exchange, New York Stock Exchange, the NASDAQ, etc. And it will hold and he's talking about a bond ETF, so a mutual fund, an exchange traded fund that holds bonds and then uses derivatives to hedge price movements if interest rates rise. Because the natural function of things is when interest rates rise, the value of bonds go down. And when you hold bonds in a mutual fund, the value of your mutual fund goes down because it has this big portfolio of bonds. And unlike an individual investor that holds bonds, it typically doesn't hold them to maturity. It's constantly trading and swapping out, etc. And so with interest rates, people considering they're going to rise and continue to rise, everybody's worried about losing money in their bond funds because the value of those bonds will go down. So enter financial engineers, where they've created a mutual fund via an exchange traded fund. I'm sure there are a number of them out there that hold bonds, but then they buy contracts. They buy guarantees on the side that try to offset the drop in value of the fund if interest rates rise. And in theory, that neutralizes or tries to neutralize that price risk in the event interest rates rise. It's a great idea in theory. The problem with it is twofold. Probably more than that, but the two I'm thinking of is, one, there's a cost to buying these derivatives, whether it's a swap or other derivative contracts, because they are like an option. You have the option to do something for a short period of time or a certain period of time, and then that option goes away. And then if you want to continue to buy another option, you got to go pay money for these things. So number one is you're not going to have your money invested in the bonds, because there has to be money to try to hedge using these synthetic derivatives. And then there's a cost to those derivatives because they have to keep renewing them. I'm not a big fan of it. The way those are structured, they're more sizzle than steak, in my opinion. Anything where we're introducing something that's manufactured and not organic changes what we actually have. And there's a lot of unintended consequences, a degradation from all these synthetic tools that are being used that don't quite give you what the promise is. I like to keep things simple. Retirement's complicated enough. Let's make the main thing so we don't overcomplicate things, because the more you overcomplicate things, the more fragile everything becomes, and we don't want that. So what do? I would say I'd forget about those, Kevin. I would look at TIPS, Treasury Inflation Protected Securities, which have inflation hedges. You could look at I bonds, which have some inflation hedges to them. Obviously, there are advantages and disadvantages of those. We talked about a little bit of that a couple months ago. You could also simply build a bond ladder. If we're talking about money you think you're going to need in the next 5 years, you could purchase a bond or a CD or a multi-year guaranteed annuity that matures on the date you think you're going to need the money, 1, 2, 3, 4, 5, 6 years out. and then earn whatever interest rate it's going to earn. And then when it matures and you get your money back. It doesn't matter whether the price went down between the time you bought it and matured. You'll know exactly how much money you'll get back at maturity and the interest that you're going to get. So if interest rates rise, you'll have money maturing that you can spend or you can reinvest at the new higher rates. If interest rates stay the same, then it stays the same. But it's a simple way of just neutralizing the impact on your spending in your life rather than worried about interest rates. So you could use those interest rate securities, or you could just simply build a bond ladder that every time one matures, you go out and build another one at the longer end. Or you could build an income floor and then have the rest of your money invested for much longer term, which would likely have less bonds. So I wouldn't go down that path if I were you. I would focus on the main things, which is funding your life. Our next question comes from Ronald on a lump sum in retirement. Hey, Roger, I was wondering if you know of a type of account that we can put the lump sum payment at retirement that we will be taking to avoid taxes on it. Can I roll it over so that by the end of the year at tax time, I won't have to show the full amount because it will put a big tax burden on my life? So Ronald, I don't want to make assumptions here. So if you're going to get a lump sum from your employer, it's really important we know in what form this lump sum is. My assumption would be we're talking about a 401k or some type of retirement plan, which would be a pre-tax account. That's what it sounds like, but I don't want to make that assumption. So I would say step one is you want to go to your HR department, your human resources department, and say, hey, what is this going to be paid out? Is this from my 401k? Is this some special comp plan that is going to pay it out as taxable income? So first, we need to understand the form that it's going to be coming to you as. Assuming that it's some type of retirement plan, then likely you would look at establishing an individual retirement account or an IRA. And you can do that at any brokerage firm, Schwab, Vanguard, Fidelity, lots of places. And then you would do what's called a direct rollover, where it would go from your retirement plan directly to that IRA. You don't want to have it written to your name. You want to have it written to the name of the custodian of your new IRA. And as long as you do that, it's not a taxable event. And then you can control when you take money out. But I would check, because it's unclear from the way you're talking whether this is a IRA or 401k rollover type of situation. So check on that, and that way you'll have more information, and then you can determine your next decision set. Our next question comes from Karen on Roth IRA and something called net investment income tax. Boom, boom, boom. Oh boy. Okay. Karen says, I am 60 years old. Does the 5-year rule to withdraw still apply to me if I do a backdoor conversion? Do I need to set up a whole new Roth to convert to, even if I have an existing Roth that's over 10 years old? Is a rollover IRA eligible to convert to a Roth? I understand converting to the top of the tax bracket each year. What is this extra 3.8 for converting over income of $250,000? Wow, you got a lot of stuff in there, Karen. So let's take this a little bit at a time. So first, the Roth IRA part. With regards to Roth IRAs and the 5-year rule, which is this quirky rule with when you can take money out when you do conversions and contributions, the pre-existing Roth IRA that has more than a 5-year history, combined with you being over 59 and a half, makes you eligible for making Roth IRA earning withdrawals without penalty. So your Roth IRA contributions can always be withdrawn without a penalty. A rollover IRA, let's say from a 401k, can be converted to a Roth, and you don't need to set up a new Roth IRA to do that. It all is going to fall under that. So you're cool there. Now, this NIIT, this NIT tax, 3.8%. It is an additional 3.8% tax that only applies to high-income taxpayers who have investment income. That money is an extra tax to fund Medicare, and IRA income is considered ordinary income. So a Roth conversion, along with any W-2 earnings from your job, is not enough to trigger it by itself, although it's part of your modified adjusted gross income. You have to also have separate investment income, such as from a brokerage account or rental property, The NIT threshold is a modified adjusted gross income of $200,000 for a single filer and a modified adjusted gross income of $250,000 for a married filer. And imagine if you're thinking of this net investment income tax that you may be thinking of doing these Roth conversions. So in the future, you can take Roth withdrawals, which won't count towards this NIT calculation later on. So hopefully that helps clarify those two things, Karen, and thanks for listening to the show. Our last question comes from Bill on using dividend investing for his retirement assets. Say, hey, Roger, I've been listening to the show for a while. It's nice that you archive your podcast. So yeah, there's lots to listen to. Maybe I'm missing something, Bill says, but I haven't heard you talk much about the value of dividends as a source of income in retirement. Upon retirement, I have a pension, which will provide me about 80% of my retirement pay. And my after-tax portfolio should provide the other 20% via dividends, which is taxed at a favorable rate, assuming they're qualified. This way, I can worry less about market volatility as I source my income. I know it takes a pretty large holding of dividend stocks to generate that kind of income, but it's something I've planned for in my after-tax investment goals for years. That seems like a no-brainer to me. I'll have Social Security, I'll have 401k assets to address inflation in the later years. Would love to hear your thoughts on this role that dividends can play as a retirement source of income, especially compared to bonds, which pay so little. Well, Bill, I think you make a great point. Generally, when we think of even after-tax investment accounts, in the accumulation mindset, we're always reinvesting the dividends that are issued or the capital gains that are issued so it can buy more shares of whatever the investment is and grow and accumulate and grow and accumulate. That's a really good strategy. But it sounds like for you in retirement, you built up a portfolio specifically that was meant to provide a decent level of dividend income. So what a dividend is for you that might not know, there are certain companies that pay cash to its shareholders in the form of money. And that is a return of the profits of the company back to the shareholders, the owner of the company, via a dividend. And if they're a qualified dividend, they are taxed at a favorable rate. There's a whole little rabbit hole we could go down on dividend stocks, but for now, let's just address Bill's question. I think that's not a bad strategy, Bill. It sounds like you have your pieces in place. What I would do is go through creating the plan of record. And it looks like you've done that in the form that you have where you know what your spending is going to be year by year. And you've accounted for, hey, I got this pension, I got this Social Security, that's going to pay for these things. And you know roughly what your portfolio has thrown off traditionally in dividends. And you say that will cover 20%. I don't think that's necessarily a bad strategy. And it sounds like you have other assets outside of this portion that we're talking about, which is cool. Where you might have issues is one, depending on the kind of dividend stocks that you have, the consistency of those dividends, as well as whether those dividends will be adjusted for inflation over a longer period of time. And in a low interest rate environment, and this goes back to a previous question, people have been searching for yields on stocks for years via dividends because interest rates have been so low. So if you have a portfolio of higher yielding dividend stocks that pay out lots of dividends or very consistently, they will have some interest rate risk. So if interest rates rise, the volatility or the downside volatility of those high yielding dividend stocks could be affected more than the whole market. So essentially, you could have more volatility if we're in a rising interest rate cycle or a long-term rising interest rate cycle. So you're still going to want to make sure you have some contingency fund or income floor, meaning money put aside to help pay for things, because you could end up having a portfolio that is a lot more volatile than you anticipated when you retired. So those are a couple things to consider there. But I don't think it's a bad tool to have as part of the strategy, Bill. I think the key is just mapping it out. So bravo for you, man.
On your marks, get set.
All right, now it's time to set a smart sprint so you can not just rock retirement, but rock life. All right, in the next 7 days, here's my challenge for you. Every morning, say to yourself, or even better, write it down, today is the day and I am blank. I am a reader. I am a stretcher. I am a great husband. I am a great wife. I'm a great friend. Write it down and get into the habit of every day having that mantra and see how that impacts your life. I'm excited about this new open enrollment for the Rock Retirement Club. We have a new software that we've licensed that's going to be part of the club. So it's added to as a benefit for the club that we're going to announce at open enrollment. That's all focused on the non-financial things and living our best life. So I'm excited to have that integrated with all the financial offerings we have. So would love for you to join us, even if it's just to hang out and say hi and ask some questions. You can go to livewithroger.com to learn more. Have a great day, all right? Hey, it's time for that all-important disclaimer. We so appreciate you listening to the show and love your questions and love the teaching that we're able to provide here. And actually, it helps us too. But remember, you're not our clients.
Not love it if you took advice from us on the show.
We would not love it if you took advice from us on the show. Realize it's helpful, it's an education. Talk to your legal advisor, your tax advisor, or your financial advisor before you make any decisions.
We appreciate you joining us today for this episode of Retirement Answer Man. Be sure to visit rogerwhitney.com/answers to access the Retirement Answer Library with over 30 checklists to help you make the most of the only life you have. Remember, you have more power than you realize to create an amazing life starting today with Retirement Answer Man. The opinions voiced in this material are for general information only and are not intended to provide specific advice or recommendations for any individual. All performance referenced is historical and no guarantee of future results. All indices are unmanaged and may not be invested into directly. Have a wonderful day.